Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about the latest Fed rate hike prediction, the drop in mortgage demand, and investing in foreign stocks. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. The stock market futures are in the red this morning with the NASDAQ heading for an 8-day losing streak. Why does the market keep going down?
Well, I tell you, this is bizarro morning here. Not only do we have 8 straight days of negativity in the market, but the Austin airport is shut down completely. There's rumors of a power outage. The roads are closed, excuse me, in and out of the airport. So, of course, that's going to cause a massive disruption when you have a major airport that's down today. But back to your question, why in the world does the market just keep selling day after day after day? You know, yesterday we started off in the green and that was going fine for about an hour. And then the market, excuse me, rolled over and continued in the red most of the day with some bright spots towards the end of the day, but it never did make it all the way to the green. So what's going on? Well, it's the fear of the Fed rate hike, right? So we've been talking about this basically all year long. We started 2020, inflation was the disease, raising rates is the cure, right? So that's the battle going on. And then the Fed was kind of slow, if you will. I think history will show that they were slower than they should have been at raising rates. Now they're trying to get more aggressive to make sure that inflation is dead. Well, the more aggressive they get, the better chance that they throw us into a recession, and not just a small recession like we're kind of having now, more of the major recession sort of thing. And it's bleeding over into the housing market, which we'll talk about in a second. But that's really what we're talking about here. We aren't due for a Fed rate hike until the beginning of next month, which is October. But now, if you look at this article on CNBC, there's an 86% chance down here. It's blinking, 86% chance of that 75-point rate hike. When before, pretty much everybody thought that we were past the 75 basis point rate hikes and we're going to go back to 50 and then kind of tapered off there, and then the problem would be solved. So that's the new information that's getting priced in. Again, the 8 market days ago was when Chairman Powell was at Jackson Hole and he said, expect more pain ahead. And that's what is throwing the market into the sell-off. So the good news is anytime the market sells off, stocks are cheaper. So I know when you look at your balances of your 401ks, or your IRAs, or your taxable accounts, you're not liking what you're seeing. I get that. But if you have new money to put in, now's the time to put it in. Or if all those dividends that are kicking off from the stocks you already own, those are getting reinvested at lower prices. So your dollar cost averaging over time, again, that's a small amount in relation to the overall size of your portfolio, but it is happening, underneath the surface, if you will. So you are picking up some deals here. And then of course you just kind of have to wait it out for the market. For all the portfolios with me, we've already gone through, we've cut the fat out of them, if you will, months ago. And now we're just best of breed holdings that we're going to hold through the bottom. We have buffer in place to mitigate the downside in most of the accounts out there. So that's the kind of the bear market strategy here while we're waiting for the market to turn. However, when you have 8 days in a row of selling, that generally, whenever it stops, that's going to mark the bottom, in my opinion. So we'll continue to follow this closely, but that's why the market's selling off.
Next, mortgage demand dropped significantly again. What does this mean for investors?
Well, the reason I wanted to, and Allison and I talked about this earlier, the reason we want to talk about this is, of the client base that I have, a couple of folks are in the mortgage industry. Well, basically 2, and both have been laid off. And that's concerning, right? That the layoffs are, if I'm 2 for 2, then imagine that it's going on widespread. I was also talking to a friend in the industry this weekend, and he said, yeah, layoffs, he's more in an executive position. Layoffs are rampant throughout the industry because the demand has dropped so much. So why is the demand dropping? Well, we talked about inflation, right? So inflation making everything more expensive. The Fed's raising rates. Well, when the Fed raises rates, mortgage rates go up. When mortgage rates go up, houses get less affordable. So again, it's not that the house is worth more or, costing more. It's the fact that for the same house at the same price, you have to pay more to get that mortgage. And mortgage rates are, 5.94% versus 5.8% last week. Are we going to go above 6? I think we have to. If we continue to raise rates at the 75 basis points in October, I think by mid-October, we're looking at, over 6% for the mortgage rate. So what does that mean to you and I, right? Probably not the best time to be buying and selling a house. It really isn't. This is more of a wait and see type market. We had a seller's market for the past year and a half where you just list your house and people show up with briefcases full of cash to take it off your hands. It's like, well, that's not the reality right now. If you think that's the reality, you need a time travel machine to go back 6-8 months ago. So if you unloaded your house at those highs, congrats. If you didn't, selling your house now, you're not in charge anymore, right? Now you need to find a buyer, which means it's going to transition quickly into a buyer's market, right? So if you're looking to buy, you hear me say it and you're like, well, if it's a buyer's market, Steve, why don't I go out and buy? Just wait. Just wait. I think there's lots of pain ahead in the housing market, so just wait for prices to come down. We looked at one house. We're not really serious about moving, but we did look at it kind of what we would call one of our dream homes here locally, and we looked at it, and it's literally $500,000 above where it should be. And I just kind of laughed at the price and said, that's coming down. Now, that means, somebody else will get the house because somebody will be dumb enough to pay it. But if you have the ability to wait, I would just wait, because this stuff's going to come back down, not crash, but certainly come in from where it is right now. So anyhow, that's what's going on, Allison, in the mortgage demand market.
Last, if an investor wants to invest in foreign stocks, what options do they have?
Well, the first question I would ask is why, but that's none of my business, right? So I tend to play things pretty close to, keep it here in the United States, keep the money working, the best economy in the world, in my opinion. So if you look at the overall, I have a stats package I put to each portfolio, and it tells you what your overall exposure is. And I want my exposure to the US, 98% plus. But that's me. If you have exposure to a foreign stock, or you want exposure to it, there's a couple ways to do it. So an ADR versus an ADS. So when you log into Schwab, I use Schwab as a custodian. You can buy a foreign stock. Alibaba, will just use that as an example. So when you buy an Alibaba's Chinese Amazon, if you will, that's a rough explanation, but certainly an e-retailer based in China, you're not actually buying, you're buying an ADR in that case, which is an American Depository Receipt. Okay, so there's behind the scenes stuff to where basically the brokers in the US buy a certain amount of the stock and bring it over, and they hold that behind the scenes, and they issue a receipt, and it's the receipts that trade here in the US. That's very different from an ADS, which is an American Depository Share, which is the actual share of the foreign-based company. Okay, available for purchase. So generally when that happens is you buy that share, and they reach out and transact on the foreign exchange and then give you, the share equivalent, but it's the exact same share here in the US. So a little bit difference. Do you care? I would say no. If you want exposure to a company, both are safe, both are, it's just different ways of doing business. If you believe in the company, you believe in the fundamentals, you want to buy some of the stock, then buy some of the stock. Okay. The trading sometimes with volume can be an issue. And that's any investment, not just US based, but I'd want 100,000 shares trading hands on at least on a daily basis before you get involved in anything. As long as the volume's there, you can own either of these, and you may not even know which one you have, actually, because it's behind the scenes stuff. But if you have any questions, contact me, contact Schwab or E-Trade or Robinhood or whoever you're going through. But if you're going to start investing in foreign companies, you're not actually transacting generally on their exchange. You're doing an Americanized version of it with a couple different methods. So that is kind of the just blanket level explanation of that topic. And that's honestly probably all you really need to know instead of what's going on behind the scenes.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.